Impulse trading doesn't usually feel like a mistake in the moment. It feels exciting. It feels urgent. It feels like clarity. That's what makes it so dangerous. The market flashes an opportunity, your heart rate picks up, and suddenly you're clicking buy or sell before your rational mind even gets a seat at the table. Later, when the trade unravels or closes for a loss, you tell yourself you'll do better next time. But next time comes, and the same thing happens again. If that cycle sounds familiar, this video is for you, because eliminating impulse trades isn't about willpower. It's about redesigning the way you think, plan, and execute, so impulses never get the chance to take control. Most traders believe impulse trading is a discipline problem. They assume the solution is to be more patient or control emotions. That advice sounds good, but it rarely works, because impulse trades don't come from a lack of discipline. They come from an unstructured decision-making environment. When your rules are vague, your setups are loosely defined, and your process leaves room for interpretation, your brain fills the gaps with emotion. Eliminate the gaps, and impulses lose their power. Let's start by reframing what an impulse trade really is. An impulse trade is not just a random entry. It's any trade that is made without full alignment with a predefined plan that was created when you were calm, rational, and objective. Even if the trade makes money, if it wasn't planned, it reinforces a bad habit. Over time, those habits destroy consistency. The goal isn't just to avoid losing impulse trades. The goal is to eliminate unplanned decision-making entirely. Impulse trading thrives on uncertainty. When you don't know exactly what you're waiting for, every price movement feels like it might be the one. Your brain is wired to avoid missing out, so it interprets uncertainty as urgency. The market doesn't need to manipulate you for this to happen. Your own psychology does the job just fine. The first real step toward eliminating impulse trades is removing uncertainty from your trading process. That begins with defining what a valid trade actually is. Not in general terms, not with phrases like strong momentum or clear structure, but in precise, observable conditions. If someone else read your rules, they should be able to identify the same setups you do without guessing your intent. When your rules are this clear, something powerful happens. Most market movement immediately disqualifies itself. Instead of asking, "Should I trade this?" you start asking, "Does this meet my criteria?" And most of the time, the honest answer is no. Impulse trades often come from watching the market too closely. Staring at every tick, every candle, every fluctuation creates a sense of constant action. The brain interprets motion as opportunity, even when nothing meaningful is happening. This is why many impulse trades occur in choppy, low-quality conditions. To eliminate this, you need distance. That distance can be physical, like stepping away from the screen, or structural, like only checking the market at specific times or on candle closes. The less noise you consume, the less urgency you feel. Another critical factor behind impulse trading is emotional accounting. Traders often carry emotions from previous trades into the next one. A loss creates a desire to make it back. A win creates overconfidence and a sense of invincibility. Both states push you away from your plan. The market doesn't know or care what just happened to you, but your brain does. The solution is to treat every trade as an independent event. That sounds simple, but it requires a system that enforces emotional neutrality. One way to do this is by standardizing risk. When every trade risks the same small, predefined amount, the emotional weight of each decision decreases. If one trade can't significantly hurt you or dramatically boost your ego, you're less likely to act impulsively. Impulse trades often come from feeling like, "this one really matters." Proper risk management makes sure none of them do. You also need to understand the role boredom plays in impulse trading. Many traders don't like to admit this, but a significant number of bad trades happen simply because there's nothing else to do. The market is open, you're at your desk, and your brain wants stimulation. Trading becomes entertainment. This is a dangerous mindset. Trading is not something you do to fill time. It's something you do when very specific conditions appear. To eliminate boredom trading, you must accept that most of your time as a trader will be spent doing nothing. That's not a flaw in the process. That is the process. Professional traders are defined not by how often they trade, but by how selective they are. When you truly internalize this, Waiting stops feeling like weakness and starts feeling like strength. Another hidden driver of impulse trades is the belief that you must always be in the market to succeed. This belief is false, but it's deeply ingrained. The market rewards patience far more than activity. Some of the best trades happen after long periods of inactivity, when conditions finally align. If you pressure yourself to trade every session or every day, you're setting yourself up for impulsive decisions. The market offers infinite opportunities, but you only need a few high-quality ones. Preparation is one of the most effective weapons against impulse trading. When you prepare scenarios in advance, you're not reacting in real time. You're executing pre-made decisions. Before the trading session begins, you should already know what you're looking for, where it might occur, and what you'll do if it doesn't. This turns trading into a process of recognition rather than invention. You're not making decisions under pressure. You're simply following instructions you gave yourself earlier. Journaling is another powerful but underutilized tool, not just recording entries and exits, but documenting your thoughts, emotions, and reasons for each trade. When you review your journal, impulse trades become obvious. They stand out in both logic and outcome. Over time, patterns emerge. You may notice that impulse trades happen at certain times of day, after certain emotions, or following specific events. Awareness creates choice, and choice creates control. It's also important to address the idea of confidence. Many traders confuse confidence with aggression. True confidence comes from trust in your process, not from taking more trades. When your process is proven and repeatable, you don't feel the need to force trades. You know that if you follow your rules, the results will come over time. This kind of confidence is quiet. It doesn't rush. It doesn't chase. It waits. Impulse trading often spikes after a streak of losses. This is where emotional resilience becomes critical. Losses are inevitable, even in a profitable system. If your response to losses is to change your behavior, increase frequency, or abandon your rules, the problem isn't the losses, it's your relationship with them. You must accept losses as a normal business expense, not a personal failure that needs immediate correction. One practical technique to interrupt impulse behavior is the mandatory pause. Before entering any trade, force yourself to wait a fixed amount of time, even if it's just 30 seconds. During that pause, you must verbally or mentally confirm that every rule is met. This small delay creates a gap between impulse and action. Often, that's all you need for logic to reassert itself. Another effective strategy is to limit the number of trades you're allowed to take in a day or session. When you know you only have a small number of bullets, you become far more selective. This constraint shifts your mindset from opportunity seeking to quality seeking. Impulse trades thrive in unlimited environments. Constraints kill them. You should also examine how you define success. If success is measured by daily profit, you'll feel pressure to trade every day. If success is measured by flawless execution, patience becomes rewarding. The market outcome is not fully within your control, but your behavior is. When you focus on process-based goals, impulse trading loses its appeal. Technology can either fuel impulse trading or help eliminate it. Alerts, automation, and predefined orders can remove the need to constantly watch the screen. If you're only notified when your setup appears, you're less likely to act on random movement. Likewise, placing orders in advance according to your plan reduces the chance of emotional interference at the moment of execution. It's also worth addressing fear, because impulse trades aren't always driven by greed. Sometimes they're driven by fear of missing out or fear of being wrong. You see price moving and worry it will leave without you. Or you enter early because waiting feels uncomfortable. The cure for this is trust in probabilities. Missing one trade means nothing if your system works over a large sample size. The market will always offer another opportunity. Consistency comes from repetition, not intensity. Eliminating impulse trades won't happen overnight. You're retraining habits that may have been reinforced for years. Progress should be measured in reduction, not perfection. Fewer impulse trades this month than last month is success. Catching yourself before entering one is success. The goal is gradual improvement, not immediate transformation. You must also take responsibility for your environment. If you trade when you're tired, stressed, or distracted, impulse control drops dramatically. Trading demands mental clarity. Treat it like any high-performance activity. Proper sleep, breaks, and boundaries matter. If you wouldn't make important life decisions in a certain state, don't trade in it either. Over time, as impulse trades fade, something interesting happens. Trading becomes calmer, slower, almost boring. That's a good sign. It means you're no longer seeking stimulation from the market. You're executing a business plan. Your emotions stabilize, your confidence grows, and your results become more consistent. This is what professional trading actually feels like. Eliminating impulse trades for good isn't about becoming emotionless. It's about building a structure that guides your emotions instead of being controlled by them. When your rules are clear, your preparation is thorough, and your focus is on execution rather than excitement, impulse trades have nowhere to hide. They don't disappear because you fight them. They disappear because your process makes them irrelevant. If you take one thing away from this, let it be this. Every impulse trade is a signal that something in your system is undefined, unprotected, or misunderstood. Fix the system, and the behavior fixes itself. Trading mastery is not about reacting faster. It's about needing to react less.